Hello and welcome to CNBC-TV18's Mumbai studio. I'm Sonal Bhutra and you're watching Your Stocks. We'll discuss and answer all your stock queries. Before we do that, let's quickly take a look at the markets because we've been talking about higher levels on the mid-cap index. The Nifty too, after seeing that slight dip, has moved higher. The mid-cap index is the one which is surging today above that 50,400 mark. That one is up 516 points and at a record high as well. The banking index too is doing well, but it is underperforming the benchmark indices. But that remains to be seen because it's a very stock-specific market and we have a packed session ahead of us as well. Joining us today is Rajat Bose of RajatKBose.com and Parthiv Shah of Tracom Stock Brokers to answer all your stock queries. Gentlemen, thank you so much for joining us today and taking all these queries. And we do have a lot of them considering the markets moving ahead and charging ahead, especially in the broader market side. So let's start with the first one. We have received an SMS from Kunal Mehra, who's writing to us from New Delhi. He holds 30 shares of NTPC at 300 rupees per share. Wants to know whether to buy more shares or keep it at these levels. He is making a small profit here. Let me come across to you first up, Parthiv. What are you considering with NTPC? Everyone's talking about that big renewable energy push. PSU stocks, they are back in favor. How do you look at NTPC in particular?
Good afternoon, Sonal, Rajata, and our viewers. Yes, absolutely, Sonal. I think very rightly pointed out. I think one of the reasons why we are seeing renewed energy in a stock like NTPC, which was languishing for years, in a narrow range, and also with the fact that now PSUs are catching fancy, along with the fact that a lot of improvement we are seeing in terms of the governance standards of the PSUs and the way they are allocating new capital. So NTPC, as we know, is India's largest thermal power company. It's bigger than most of the other private sector peers as well. Not only that, the incremental cash flows they've deployed a lot in the renewable energy space, and they have huge targets going right up to 2028, 2030. As a matter of fact, they've been even vocal about, coming out with an IPO separately for the renewable part of the business, which is what is definitely driving a lot of interest from investors all over, including the ESG sort of investors who invest. And I think a lot of unlocking will take place. Not only that, the existing thermal power plants are operating at very good plant load factors, plant availability factors. NTPC also has a lot of integration in terms of its coal mining assets, where the coal mining has been going up, and they're targeting to reach almost 50 million tons of coal mining over the next 3 years. So I think a lot of operational efficiency have kicked in a lot of such PSUs. The dividend yield, despite the fact that it's lesser than what it used to be 2 years ago, it's still very attractive. And going ahead with additional cash flow generation, I believe that more dividends will be doled out. So we are suggesting a hold here on NTPC. In terms of further re-rating, there's still a 20-25% upside over the next 1.5 years.
Okay, so clear hold on NTPC. Rajat, chartically, how is this one looking? And if not NTPC, anything that you're liking from the PSU space?
NTPC is quite good because there had been a fall in the recent past to about 309 or so from levels very close to the current levels, around 350 to 309. And then it is a one-way traffic. And what has that done technically? We have seen that the 50-day moving average, the 20-day moving average, and the 9-day moving averages are all moving up and giving a strong signal that the bull run is here to stay. So I would suggest that this gentleman, if he is a short-term investor, then the stop loss should be placed below 350, or if he is an intermediate-term investor, let the stop loss be at 325 and continue to carry on. There is no point projecting some levels on the upside. Just carry on. It does pretty well. It is going to do well the way the momentum is there at the moment. So it's a hold, and I completely agree with Parthiv.
Okay, all right. So it's a hold both from the short-term level and the long-term level as well. Let's go on to the next one. Prabha Gupta is writing to us from Hyderabad, holds 50 shares of JSW Steel at 800 rupees a share, wants to know whether to hold or sell at current levels. Well, metals is something that we can all talk about. It's up and down. It's up and away, actually, not up and down. Rajat, how are you looking at this particular name?
This one is pretty lumpy. I mean, sometimes it moves up, sometimes it comes down. It forms a saucer pattern. At the moment, a medium-term saucer pattern is getting completed, but there is quite a bit of supply around the level of 890 to about 870. So if it were to cross 900 and sustain there, then you can see further upswing happening. Maybe 925 to about 937 would be the next short-term target. And put a stop loss below 850 if you are holding it for the short to medium.
Okay, all right. So that's on JSW Steel. A bit lumpy, but that's what's happening with the metal space. But they have made a comeback in last couple of trading session. Parthiv, what's your take? Do you like JSW Steel, or do you think to play the metal rally, you should be looking at some other stock?
I think the investor has a long-term horizon. I believe JSW Steel is one of the finest steel stocks. We know for the fact that they are one of the lowest cost producers. They didn't have entire backward integration of iron ore and coking coal, and yet I think they've been operationally extremely efficient. And in the next couple of years, they'll be touching a capacity of almost 37 million tons, and they have a target of touching almost 50 million tons of steel capacities by 2030. So I think going ahead from next year onwards, we'll be seeing incremental volume growth in this company. And the good news is that they've always guided for higher share of value-added steel, and most of the new incremental capex, brownfield and greenfield, even including the electric arc furnace capex, is going to come in very high-grade steel, which will add to their share of value-added sales. And currently, if you look their product mix, 50% of their sales comes from the value-added segment, which brings in better incremental margins. Going ahead, I think they're targeting almost to the tune of 60% of sales in value-added. So if the investors a longer-term horizon, I think the prospects are looking extremely good for a steel company like JSW Steel.
Okay, all right. So that's on JSW Steel. Moving on to the next one, Vignesh writes to us from Tamil Nadu, holds 15 shares of Thyrocare at 1120 rupees since 2 years. He wants to know whether to book his losses or stay invested. Well, so much has happened with Thyrocare in last 2 years, gentlemen. We've seen that acquisition, the promoter selling the stake, complete stake. In fact, how do you look at this one? Are there better peers that one can look at, and should the gentleman actually book his losses at current levels, because it's almost half from those levels? Parthiv, let me come to you first up.
We're not at all upbeat on Thyrocare, because I think if you see since its IPO, if you see, I think a lot of competition has creeped in the pathology segment, and there's been immense pricing pressure for companies like Thyrocare. And more importantly, if I compare Thyrocare with peers like Dr. Lal Path, at least Dr. Lal Path has some sort of value-added tests where they earn higher revenues per test. And that is a key distinguishing factor between a player like Thyrocare, which is more commoditized and in nature at current juncture, versus a better run company like Dr. Lal Path. So I would suggest the investor that even currently the valuations are still expensive at around 48 times forward multiple. We prefer Dr. Lal Path in this segment, which is far better run and has a better pipeline of tests going on.
Okay, all right. So prefer other names in the same space. Rajat, what about you?
Well, Thyrocare touched a high of, I think, 1465 in June 2021. And after that, there had been a 1,000-point fall. It came down to as low as 415. That was last year, 27 March. After that, it is languishing, trying to move up. Now, it needs to take out its 200-week exponential moving average. If it does that, then there will be a good recovery. But now it is struggling. I would say that if the gentleman has actually stayed for so long, maybe there is a likelihood of an upside breakout, and give a stop loss of about 575 or 550, whichever you are comfortable, and continue to hold on, because you have gone through all the pain, and now when there is a possibility that there might be a bounce back, why get out right now? At least wait a bit and see. If it does, then it would be good for you.
Okay, all right. So there is a possibility of a bounce back as per the charts. Thank you so much for that helpful advice, Rajat. Let's move on to the next one. Gurminder Bedi writes to us from Punjab, holds 50 shares of Infosys at 1310 rupees a share. He's a long-term investor and wants to know future prospects of his investments. We'll be kicking off the earnings season with TCS on Friday. Rajat, let me come to you. How are these IT stocks looking when it comes to the charts, and any specific name that you like from all of them, and your take on Infosys as well?
Well, Infosys it did embark on an intermediate uptrend, but that intermediate uptrend got terminated around say middle of February, when Infosys touched 1709. After that, it is coming down. It has actually fallen below 20-week, 9-week, 50-week moving averages. That means 200-day moving average has also been breached. So my suggestion is that, see, conventional software services companies, if you can shift, I have a particular predilection because I personally hold LTTS in my portfolio, and I would recommend stocks, not LTTS, just LTTS. You can actually get into ER&D software companies. They will make much more money compared to the common software services companies. So you can choose LTTS, or you can go for Tata Technologies, or say maybe other stocks like KPIT. KPIT's margins are the best in this in this whole lot. But my personal preference, of course, goes to LTTS. That's what I'm holding at the moment.
Okay, LTTS from the mid-cap space is what Rajat likes. I have to ask you, Parthiv, on this. What do you like from the fundamental space when it comes to IT? We have TCS coming out on Friday. The guidance is something everyone will be watching out for FY25. What's your take?
See, if you look at all the frontline IT names, I think they're quoting at least 10 to 15% valuation discount as compared to its last 5-year averages. The good news is that most of the companies in the last quarter did hint at the fact that if not quarter four, but FY25 should be a slightly better year as compared to what it was from FY23 to FY24. No doubt, I think the US economy is looking quite stable. There hasn't been major soft landing, the talks that were happening, and even the European business, I think the demand is slowly, gradually catching up and coming back. Only time attributed to the fact that the frontline IT names like TCS, Infosys are quoting at reasonable valuations. We are more tempted to suggest such frontline names because a lot of mid-cap IT names are still quoting at very expensive valuations. So we would like to wait out and see how the quarter four results pan out, and if at all, what sort of constant currency guidance they're giving. Unless and until these mid-caps don't guide for upwards of 15 to 18% sort of a growth guidance in constant currency, the current valuations might not be justified. So vis-a-vis, I think the large cap names are not building in a lot of expectations going into the results. So I think Infosys and TCS look reasonably good to play out for the next 2 to 3 quarters.
Okay, all right. Take that point. Gentlemen, we'll continue this conversation on the other side of the short break. And as we do that, we have an announcement to share with you all. We're launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate Personal Finance Handbook with Sonia Shenoy, where she'll be joined by 3 well-known experts on Saturday, 11th May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth, be it insurance, tax saving, managing your portfolio, retirement planning. There's lots to do and lots to learn. Whether you're in 20s, 30s, or even 40s, this live webinar is for you. We have limited seats, so do not miss this chance. Register now. Scan the QR code to register or log on to cnbc-tv18.com, and we'll see you on 11th May. Welcome back. You're still tuned into Your Stocks. We have with us Rajat Bose and Parthiv Shah. They are here to answer all your queries. Let's get going to the next one now, gentlemen. Kiran Sinha is writing to us from Bihar, holds 30 shares of JBM Auto at 2,983 rupees a share, is a long-term investor and wants to know whether to stay invested or book his losses. Well, you know, this has been a stock which has seen a one-way rally. The new orders, the EV buses, all of that has kept the stock very excited. There's a marginal loss that the viewer is making here right now. Parthiv, let me come to you first up. Do you think it's overvalued now and the rally that we've seen in terms of future growth prospects is already in place, or there's still more to go here?
See, I think my biggest concern here is the valuations. No doubt, if you look at the business divisions, which is the auto components and systems, the buses and the electric vehicles, the electric vehicle aggregates, the charging infrastructure that they've been talking of, renewables, a lot of these buzzwords, I think, have done the round and has allowed the stock to get massively re-rated. No doubt, I think the company has also executed quite well. They have very good order book in terms of the EV buses from the state governments. But I think at the current valuations of almost 110 times forward multiple, I think we are very, very skeptical to invest on such valuations. I think the stock is prohibitively expensive. And if at all there is miss on 1 or 2 quarters in terms of either margins or in terms of volume growth, probably we might see a lot of derating taking place. So I would suggest an avoid on this count at this stage.
Okay, avoid on JBM Auto. Valuations are something that you're not very comfortable with. What about you, Rajat?
This stock moves up for several months. Say last move happened from 26th October 2023. The low was 1113, and from there it went up to something like 2450, more than double, I suppose. And after that, there is a 60% fall of the total rise, and now it is consolidating. So I would say that if you are holding it from higher levels, probably the correction is getting over. And if it doesn't fall below 1600, which is a critical support area, then you can expect some kind of a bounce back. Even if you were to exit from the stock, then wait for a bounce back. If it manages to get past 1800, then stay put, otherwise exit.
Okay, all right. So that's the take on JBM Auto. As Rajat was pointing out, it sees one-way rally and then there's a sudden fall from the highs as well. Moving on to the next one, Pranav is writing to us from Noida, holds 50 shares of IndusInd Bank at 1,500 rupees a share. He asks if he can buy more shares. This is a question to both of you gentlemen. Let me start with you, Rajat. At current levels, what does this stock look like?
See, IndusInd Bank had a top close to about 1,700. That was early this year. And after that, it is testing its 200 exponential moving average. Already 3 or 4 tests have been done. Now it is on the higher side of the small range of, say, 1550 to about 1390. If it manages to take out, say, something like 1575 to 1700 resistance zone, then you can expect 1700 to be retested. Otherwise, if it were to fall below its 20-day moving average around, say, 1518 or so, then you exit. Otherwise, I would suggest you stay put. If there is an upside, then you can actually carry on.
So he can carry on. He wanted to know that if he can buy more shares at these levels, and you suggest he does?
No, I won't suggest to buy more.
Okay. What about you, Parthiv?
See, the long-term fundamental view is that the stock is currently quoting at around 1.8 times forward price to book multiple, which is not very expensive for a well-run private sector bank. Good news about IndusInd Bank is like last couple of quarters we've been seeing in a very difficult environment to garner deposits. I think their deposit growth has been pretty healthy. So if their loan disbursement growth has been around 18%, the deposit growth has been to the tune of 16%, which is a lot better than a lot of their peers who have been struggling to garner more of the deposit growth. And probably that's one of the reasons why the NIMs at IndusInd Bank have held steady at somewhere around 4.3%. And going ahead also, I think the bank has focused well on the liability franchise. Their vehicle finance growth has done extremely well. The Bharat Finance, I think, book is sitting at around 40,000 crores. That has also grown reasonably well. So overall, I think the product mix is looking pretty good. They had slippages of around 1,700 crores, but quite manageable. I think 1 or 2 good quarters and probably the stock is surely undervalued. But for long-term investors, I think at current valuations is attractive, and I believe there could be re-rating going here.
Okay, all right. So that is about IndusInd Bank. Let's go on to the next query. Ram writes to us from Chennai, holds 100 shares of ITC at 411. Wants to know if we can hold the stock for a longer term perspective. I have to come to you for this, Parthiv, because the gentleman has bought these stocks at the higher levels because the rally started from 200 and since then it has been a one-way rally, but it has consolidated around these levels. What is your suggestion?
See, in a type of market environment we are in, Sonal, I think a lot of debate is whether how the valuations are for the large cap names or the mid cap, small cap names. And here is ITC, which gives a lot of valuation comfort, because if I look into its valuations of around 23 times forward multiple, and if I have to consider it as an FMCG proxy, I think it is still quoting at a 20-30% discount to most of its FMCG peers. Operationally, I think ITC has one of the most superior cash flow generating abilities, especially free cash flow generation of upwards of 12,000 crores. The cigarette business margins are extremely good. The hotel business is turned around extremely well and doing very well. There are chatters of the hotel business being demerged, things like that, and value unlocking. Even they have IT business, the paperboard business. All of them are reasonably stable. The e-chopper, like grill-related business. I think all of that adds a lot of value to ITC. And most importantly, the FMCG business has been growing at a very reasonable pace. And going ahead, if the rural market also were to pick up, we'll see better volume numbers from there. But at 23 times, I think it's a value buy. So I would suggest a hold. And if there's any decline in the valuations from here, it's definitely a buy.
Okay, Jen, we had a lot more queries, but we have run completely out of time. So Rajat and Parthiv, thank you so much for joining us and patiently answering all those queries from our viewers. That's all we have on the show, but do remember to email us your queries and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.